I'd like to welcome everybody to today's Point and Figure Charting Basics course. Today's course will start out with the differences in fundamental versus technical analysis. We'll discuss the different charts available for traders and investors, and then we'll proceed to talk about point and figure charting itself. Starting off with the number one reason why we should use point and figure charting. From there, we'll discuss the key characteristics and attributes of a point and figure chart. And then we will learn how to build a point and figure chart. We'll use the three-box method, which is probably the most popular point and figure chart method used today. We'll discuss how support and resistance lines are used. We'll go over the many chart patterns available to us. And we'll learn how to use price objectives to maximize our point and figure charting analysis. And finally, we will have a small discussion on advanced indicators and tools that can be used in conjunction with point and figure charting to help us maximize our investing and trading decisions. There are two general schools of analysis used by today's investors and traders, the first being fundamental analysis and the other being technical analysis. The fundamental analyst is primarily focused on determining the intrinsic value of a security. Intrinsic value can be derived from a numerous amount of factors such as economic data or company-specific factors such as cash flow. Once the investor or the analyst has calculated the security's intrinsic value, he or she will compare that to the market price. Investors would consider purchasing securities, for example, if the market price was lower than the intrinsic value. Technical analysis, or as some call it TA, involves the study of price action. Through the study of trading patterns, trend lines, resistance, support, the TA analyst is able to predict future price movements. The basic premise of technical analysis is that a security's current price discounts all available information available in the market, and that price movements are not random, and that patterns in price movements in many cases repeat itself. Another important tenet of technical analysis is once a trend in prices has started, it's more likely to continue than in reverse. Technical analysis uses charts to simplify the study of price action. The four basic charts are 1. The line chart, 2. The bar chart, 3. The candlestick chart, and 4. The point and figure chart. The line chart is the most basic of these four charts. It only represents the closing price over a set period of time. Line charts do not provide any type of additional information as a trading range, such as high, low, and opening prices. Bar charts. Bar charts are one of the more popular charts used by traders today. Bar charts provide additional information that are not available in the line chart. Each data point can consist of additional data such as the high, low, which can provide the trading range, and the opening and close. Many traders find this additional information very useful in their decision-making process. Candlestick charts. Candlestick charts are essentially another style of bar chart that are used to describe price movements over time. Candlestick charts have become very popular because of the ease of identifying if prices are closed higher or lower, which can make it easier for the trader to, at a glance, determine if prices are getting better or getting worse. What also makes a candlestick much different than a bar chart is that the candlestick body is composed of a body that's either black or white and a lower and upper shadow. The area between the open and close is called the real body, and the prices above and below the real body are called shadows. Point and figure charts. When an individual is first exposed to a point and figure chart, you can clearly see the difference between, say, a bar chart or a line chart. The point and figure chart is really concerned about price movement and not really concerned about time and volume. What the analyst hopes to do in the point and figure chart is remove out any type of noise by filtering out insignificant price movements, which can distort the primary price trend. The analyst is also trying to eliminate the effects of time that it has on the chart. Which chart should you use when you're making your investment and trading decisions? We'd recommend using the point and figure chart. And the reason why? Point and figure charts, one, help simplify decision-making processes. The charts are very easy to understand, and it's based on pure economic principles such as supply and demand. 3, it allows an investor or trader to quickly identify where and how strong supply and demand is building. 4, it's very easy to immediately see if the chart is bullish, bearish, or range bound. 5, it's easy to analyze trends, once again to see support and resistance levels. 6, you can determine if the stock is undergoing a phase of distribution or accumulation. 7, it's very easy to identify entry and exit points without risky subjective guesses. 8, it's easy to make price forecasts with point figure price targets. 9, both a charting system and trading system can be combined into one complete system. 10, it can be used for any kind of financial instrument such as a stock, foreign exchange, commodities, or any other type of financial instruments. And lastly, point and figure charting has been proven to be a profitable trading system for more than a century. Now let's take a closer look at a point and figure chart. What we have here is an example of a point and figure trend chart. The reason why it's called a trend chart is because it shows support and resistance lines that determine whether a chart is above or below a trend line. Some of the key points to look at the chart is you'll notice that there are X's and O's. An X represents that the chart is rising, which would be a bullish trend. An O represents that the chart is declining, which would represent a bearish trend. You'll also notice that some of the columns have numbers or letters in place of an X and O. What the numbers depict are months. 1 is January, 2 is February, and 3 is March. This continues until October, which is A for October, B for November, C is for December. This is because 2-digit numbers won't fit in the box. From the vertical axis is the price scale. From this you can determine the value of each row. Bullish support lines and bearish resistance lines help us determine if the trend of the stock, in addition to the column of X and O's, show if the chart is currently bullish or bearish. Continuing with some more key points or attributes of a point and figure chart, it's important to understand that point and figure charts have parameters, which are known as box size and reversal size. A box size means the price amount for each plotted figure. For example, a 1-point box size is charted for every box X or row that corresponds to, say, for example, $1. A reversal size determines when you move over to a new column. In the 3-point reversal method, the price has to reverse 3 full boxes. For example, either 3 X's or 3 O's before you can move into the next column. In the normal 1-point box size with a 3-point reversal column, they must have at least 3 X's or 3 O's. This is the standard chart. You can use any other type of parameter or reversal size that you're comfortable with, and that's all based on your personal preference and the type of financial instrument that you're trading. Usually one column will only contain either an X or an O, and when the prices reverse, you'll plot a new column. However, in the Wyckoff method, or the traditional point figure method, you can have both X and O's in the same column. The price reverses immediately after one figure has been plotted. Point and figure is usually used in the mid to long range or long-term trading or investing based on end-of-day data. However, it's very flexible and can be used for day trading, which we call intraday trading just as well, based on tick, minute, or hourly data. It's really independent on the time frame. Now let's cover some of the chart basics. The details of individual chart characteristics will start with the value or price column. The scale for a point figure chart is on the left-hand side or the vertical axis. By looking at the price increments of the scale, we can determine the box size at that level. Box sizes. Changes are determined by the price range of a stock or security that you're trading. What we have here is an example of a guide to create a default scale for stocks. Note that the scales for indices, commodities, and ETFs will vary based on the security. The goal is to create a scale that provides for an orderly chart pattern. For example, the purposes will focus on using box sizes for stocks, just to make things easy. Box sizes for stocks. For example, if the stock price is trading between $0 and $5, most people will use a box size of, say, a quarter. Stock price trades between $5 and $20, the box size is 50 cents. Stocks trading between $20 and $100, it's typical to use a $1 box size. Stocks between $100 and $200, most often $2 is the box size. And over $200, you will see $4 box size. If you're trading mutual funds or ETFs, it's a little bit different. ETFs, just to clarify, are baskets of stocks that move slower than individual names. So it's a good idea to start with a scale of 50 cents per box and then make your adjustments there based on your experience. The reason we use different box sizes is to account for the volatility that's inherent in each instrument. Constructing a chart. Let's go over some ground rules to understand how to construct a chart. We did touch on it before, so now we're going to go over some basic understanding of how to build a chart based on a 3-point method. The first thing you need to understand is that point and figure chart uses either the high price and the low price for each trading day, or the closing price of the trading day. 2. The chart always continues in the current column if possible, according to the reversal size. 3. In a normal 3-point reversal chart, a minimum of 3 boxes are required to change columns. Let's take a look at this flow chart here. This can simplify or help you understand what needs to be done for updating a point figure chart. So the first thing you have to do is 1. Continue the current column with an X or O. If the answer is yes, you mark the appropriate boxes. If no, then you have to find out, does the stock actually reverse? And if the answer is no, then you move on to the next chart. If the answer is yes, you move over one column and mark the appropriate boxes. You must have at least 3 X's or O's to reverse. Does the stock reverse columns on the chart? If the answer to the flow chart question was no, then we must determine whether the chart reverses direction, thus changing columns. We use a 3-box reversal method to determine a reversal. The 3-box reversal method, the price action of a stock is marked by 2 different columns. By X's for the price moving up and O's for the price moving down. In other words, X's represent demand and O's represent supply. To move from one column to the next, X to O's or vice versa, point and figure charts require a 3-box reversal. What this is saying is that the stock or the security must be able to move 3 boxes before it can change columns. The stock or security, for example, is in an X at 35, then it must fall 3 boxes to reverse into a column of O's. This would be $3 since the scale of the chart at $35 is $1 per box and it must reverse by 3. Here's a guide to help you understand reversal requirements. From $0 to $5 price of a security or stock, it would be 75 points for a reversal. From $5 to $20 stock, it would be $1.50. 20 to 100, it would be $3. 100 to 200, $6, and 200 above, it would be $12. Does the price action continue the current column with an X or an O? Whichever column the chart is in, you remain in that column as long as the stock continues moving in that direction. This is what makes point and figure charts very valuable tools in identifying trends. If the chart is currently in a column of X's, your first question is, did the stock rise 1 full box or more in the chart? If it did move 1 full box, then you record that move by adding another X to the column. You're now done updating that chart for the day. As mentioned above, when charting, you're concerned with the price, which causes the chart to continue in the current column. In other words, we are establishing an action point. If the chart is in the column X's, you're looking at the high price of the day, rounding down to the next whole number. If the chart is in column O's, you're looking at the low price of the day, rounding up to the next whole number. For example, if a stock has a high of $58.87.5, for charting purposes, we would chart that at $58. It's not high enough to be close to 59. Continuing with the current column or X's, we have to ask ourselves, when you look at the low, you go up to the next whole number. Using the same example, a stock has a low of 48.87.5, you would read a low of 49. For smaller box sizes, you still round the whole numbers in the box. For example, in the 50-cent box, if the stock trades at 56.64, you would mark it up to 15.5, not the $16 box. With a quarter box size, the stock trades at 373, for instance, you would mark it to 350 and not 375. The 373 is not high enough to mark it up to the 375 box. Well, does the stock reverse columns on the chart? Let's show an example for a stock priced from a penny to $5 using a 25-cent box. As shown in this example, the price has to move up a total of 75 cents to complete a 3-box reversal. You can see the stock went from 250 to 325 is a total of 75 points. That would indicate a reversal on the upside. Where the stock moved down from 350 to 275 for a total of 75 points, that would also be a reversal on the downside. Here's an example of a stock reversal for a $5 to $20 price range using a 50-cent box. In this example, the prices need to move $1.50 to make a full reversal. A reversal up, a move from 6 to 750 is a total of 1.5 points. On the downside, the move is from 8 to 6.5, a total of 1.5 points. Another example for the $20 to $100 is the stock needs to move 3 full points to make a full reversal. See how on this chart a larger point move is needed than the previous two? On the reversal up, you can see a move from 44 to 47 is a total of 3 points. The reversal down is a move from 48 to 45, and that again is a total of 3 points. Now here's another example for the flowchart question, does the stock reverse? Using $102 to $200 chart, which is a $2 box. As shown in the example, the stock would need to move 6 points since it's a $2 stock to make a full reversal. So reversal up, you see the move from 126 to 132, which is a total of 6 points. And on the downside, it has to move from 134 to 28 for a total of 6 points. Continuing with the stock reversal criteria, it's important to understand that if a stock does not meet the criteria to reverse, then there's no action on that chart for the day. Unlike a bar chart, a point and figure chart won't necessarily make a movement every day. The price action of the trading day goes or does not continue in the current direction or change columns, and no mark is made. This allows the trader or investor to purely focus on the price action. For example, using a 1-box chart, you can see a stock trades as high as 42.5 and as low as 39.87.5. You can see that 42.5 is not high enough to add an X, and 39.87.5 is not low enough to add a new column of O's. Support levels. Support levels indicate a price at which most investors feel that prices will move higher. This is caused by sufficient demand for a stock or security to cause a halt in a downward trend and turn the trend up. You can spot support levels on a point figure chart by looking for a horizontal row of O's that mark the bottom of their respective columns. When the support level is penetrated, which means the price drops below the support level, it often becomes resistance. This is because investors want to limit their losses and will sell later when prices approach the former level. Looking at this chart, you can see support at $26. Like support levels, resistance levels are horizontal lines on the P and F charts. They mark the upper level for trading, or the price at which sellers typically outnumber buyers. You can find them by looking for a row of X's. When resistance levels are broken, the price moves above the resistance level and often does so decisively. On this chart, you can see resistance being formed at $33. Upward trend lines. Trend lines serve as a guide for the uptrend of a stock. The trend line has a habit of acting like a brick wall. Stocks will often come right down to the bullish support line and then bounce off. To draw the support line, you should first have a buy signal off the bottom, go to the lowest column of those, and begin to draw a line up at 45-degree angle. One interesting thing about trend lines in a point figure chart is that the angle will always be 45 degrees. Downward trend lines. Downward trend lines have the exact opposite effect of the bullish support line. The downward trend line serves as a guide for the downtrend of a stock. The downward trend line also acts like a brick wall. Stocks will continue to rally right up to the bearish resistance line and now bounce right off. To draw a resistance line, you should first have a sell signal from the top, go to the highest column of X's, and begin drawing a line down at a 45-degree angle or a 135-degree angle. Once a stock is well below the bearish resistance line, a short-term resistance line can be drawn. The bearish resistance line must be violated and not just touched in order to turn to a positive trend line. Now that we have a basic understanding of how to construct a point figure chart and gone over some of the basics of trend lines, let's talk about chart patterns. We're going to start with some bullish patterns. The double top. The double top is the most simple buy signal. It's where a stock rises above the tops of two previous up columns. Take a look on the right. This signal is the basic ingredient for many actionable signs listed below. In its own right, it definitely requires a confirmation by the main trend and a positive relative strength, which we'll go into later. The triple top. The triple top is similar to the double top, but the area of resistance above the up columns is stronger, so it takes 2 attempts to break out. These signals work best when the main medium-term trend is bullish and is combined with other indicators such as positive relative strength. Risk management can be used by placing stops below the previous down column. Continuing with bullish patterns, we have the bullish catapult. This formation can be looked at as a triple top buy followed by a double top buy, and is effectively a failed bull trap, which we'll talk about in the sell signals. The price failed to follow through on its first breakout and pulls back the bull trap, only to reverse again to the upside. The bear trap. This formation comes about when a stock breaks below a triple bottom and then reverses back up to the up column without dropping even one more box. When the triple box is broken, a number of stop losses will have been triggered, and the chances are good that a lot of short sales would have been initiated in the downside breakout. These bears will effectively be trapped, and their subsequent liquidations will add to the upside momentum. Typically, one will enter the stock on the reversal. The bullish shakeout. Many experienced traders will tell you that the first sell signal in an uptrend was really a buy signal. The criteria for a shakeout formation is as follows. 1. The first sell signal in an uptrend from a double top. 2. Above its bullish support line. 3. It's broken its downtrend line. 4. It has bullish relative strength. The stock generates a simple sell signal but fails to move more than 3 boxes lower, then reverses back up. Typically, one can enter the position on this reversal. The long tail down. I'm sure many of you probably have heard the market expression, never try to catch a falling knife. But using the long tail down strategy, it can be a good time for long-term bottom fishing. The first criteria is that the stock has to be dropped into a major support area, which would be the green zone on a relative strength chart. 2, the relative chart or strength chart has to be basic. 3, the market is becoming oversold after an important downtrend, and breadth indicators such as the New York Stock Exchange Bullish percent are low and moving to a bull alert status. 4, the stock has dropped by 20 boxes or more straight down. This is generally a contrarian pattern. The low pole. This formation comes about when a down column extends by more than 3 boxes from the previous down column, but then retraces by more than 50% of the down column. This formation is excellent for generating signals on indicators such as the advanced decline line. It's also very good in mutual funds and used as a buy point rather than waiting for a move above the previous top. Moving on to bearish patterns. The double bottom breakout. The double bottom breakout is the most simple sell signal, and when a stock breaks below the previous column O's, you have a double bottom breakout. This signal is the basic ingredient for many of the actionable signals, which we'll talk about. In its own right, it definitely requires confirmation by the main trend. The triple bottom. This is similar to the double bottom, but it takes 2 attempts to break out. These signals work best when the stock is below its bearish resistance line. As you can see in the chart here, the sell signal appears when it penetrates the 3 O's at the bottom, indicated by the green O. The bearish catapult. This formation can be looked at as a triple bottom sell followed by a double bottom sell. The price action failed to follow through on its first breakout and rallies, only to reverse again to the downside. A failed bull trap. Pullback after multiple X's up. This signal indicates when it's a good time to take profits, but not necessarily to go short. More often than not, a solid correction will happen after this takes place, and in some cases it will prove to be the final top. The bull trap. Traders will typically initiate longs on double tops and are oftentimes a little bit early on entering their positions. When stock breaks out through a triple top or a double top and pulls back right away without moving up one more box, this action effectively traps the bulls who initiated by the false breakout. The broadening top formation. This formation is particularly useful for stocks that have already had a good move up and are close to the prior highs. This pattern can be spread out over more columns than in this basic example. But the key is to look for the following formation of columns: a high, a low, a higher high, a lower low, and finally a higher high. One of the unique features of price and figure charting is the ability to forecast price objectives that are not subjective. In point and figure technical analysis, price objectives are derived by either using the horizontal count or the vertical count. The vertical count, for example, to determine a buy signal, you would count the number of X's to the right of a low point and multiply the box size and multiply by 3. For example, the stock generated a triple top buy at $36 and the low point was in the first column was down to 30. We therefore count the column of X's next to this column, which would be 5 boxes multiplied by the box size, multiplied by 3, which equals 15. To get the price objective, we add 15 to the low point, which is $30, plus 15, which equals a $45 price objective. Using the vertical count to determine a price objective for a sell signal, one would have to count the number of O's to the right of the high point, multiply by the box size, and multiply by 3. For example, 4 boxes in the down column to the right of the high point at $36 multiplied by the box size of $1 multiplied by 3 equals 12. Price objectives would subtract 12 from the high point, 36, which would equal a price objective of $24. Price objectives are also determined by using the horizontal count method. The horizontal count is taken by counting across the base a stock is built, multiplying by 3, and then multiplying again by the value per box. This is similar to the vertical count, except you count horizontally across the formation as opposed to the vertical move off the bottom. In a buy example, assuming a 3-box reversal, count the number of boxes across the base of the formation that is given a buy signal. Multiply that number by 3 and add it to the price associated with the lowest X. For a sell, you would reverse the procedures for a sell signal. Let's use an example for the buy. With a base of 4 boxes across, multiply times 3, which will equal 12, then add that to the base. In this example, to the right, we're using $30 base plus 12 would equal 42. 42 is the upside objective. Now let's review the horizontal count and show how to determine the calculation for a sell signal. Assuming a 3-box reversal, count the number of boxes across the base of the formation that is given a sell signal. Multiply that number by 3 and subtract it to the price associated with the highest O. For example, 3 boxes across, 3 times 3 equals 9, and 32 minus 9 is 23. 23 is the downside objective. Advanced indicators and tools. There are a number of advanced tools and indicators that can be used together with point and figure. These indicators can and should preferably be plotted as point and figure charts. This way, you'll be able to create a unified way of charting. By using point and figure to plot these indicators, you will get the same benefits as when using point and figure for plotting stocks. For example, clear signals, easy to understand. Some of the tools we'll go over will be with sector rotation, relative strength, bullish percent, the advanced decline line, 52 new week highs and lows, overbought, oversold indicators, and the 10 moving average percent. Sector analysis. Sector rotation is an investment strategy involving the movement of money from one industry sector to another in an attempt to beat the market. Certain sectors of business profit more in certain stages of an economic cycle. This simple understanding provides a useful roadmap for traders to follow. By identifying which sectors or groups of the market are performing the strongest or the weakest, we can increase our probability of success by trading in the direction of the overall market's trend. For example, depending on where we are on the economic cycle, one might want to participate either in consumer staples, financial services, capital goods, energy, healthcare, all depending on where we are on the economic cycle. Relative strength. Relative strength allows us to analyze the overall market quickly to identify which sectors are performing stronger than the market and which sectors are performing poorer than the market. Relative strength, as the name implies, simply measures how one sector is doing compared to another. Relative strength can also be used to determine, for example, the strength of a stock versus the sector it belongs in, the strength of a stock versus the entire market, or the strength of a stock versus another stock. In the example given here, the relative strength of energy versus the S&P 500. You can see how the energy sector did in relation to the S&P 500. In a bullish market, we always want to buy the strongest stocks in the strongest sector relative to the market. In a bearish market, we always want to sell short the weakest stock in the weakest sector relative to the market. We can use sector analysis in combination with relative strength to determine which sectors we should be in, and then pick the strongest or the weakest in that sector depending on if we are bullish or bearish. The bullish percent indicator is a contrary indicator used to identify market tops and market bottoms. It simply measures the percent of stocks, in this example, that are on the New York Stock Exchange that are on a point and figure buy signal. When the bullish percent is in a column of X's, it indicates bullish strategies, and when the bullish percent is in a column of O's, it suggests bearish strategies. There are two lines of importance on the bullish percent chart that indicate market reversals. The 30% level and below is a low risk area, and at these levels, most everyone who wants to sell has already sold, which would indicate that it might be a good time for a market reversal and one might want to go long or buy. Conversely, when the bullish percent gets to 70% and above, we are in an area which we call the high risk area. We should sell, and at this level or higher, it's most likely that everyone who wants to be in the market has already bought. The bullish percent indicator can be used for any index, for example, the NASDAQ, FTSE, or any stock exchange or list of stocks that you determine yourself. The advanced decline line, also known as the AD line, is a widely used measure of market breadth. It's a cumulative total of advancing and declining issues indicator. When compared to the movement of the market index, the AD line has proven to be an effective gauge of the stock market strength. The AD line is helpful when measuring the overall market strength. When more stocks are advancing than declining, the AD line moves up, and vice versa. By studying the trend of the AD line, you can see if the market is in a rising or falling trend, if the trend is still intact, and how long the current trend has prevailed. Another way to use the AD line is to look for a divergence between a market index, like the Dow, and the AD line. Often at the end of a bull market, one can see that the AD line begins to round over or roll over while the market is still trying to make new highs. New highs and lows is one of the broad measures of how bullish or bearish the market is during a particular time. New highs and new lows represent the number of stocks hitting 52-week highs and lows. By examining the quality of companies and which sectors are making new highs or lows, we can gauge if the market is boiling over or possibly awakening from its doldrums. An overbought and oversold indicator seeks to determine when prices have moved too fast and too far in either direction. An overbought or oversold indicator can be applied to a single stock, a defined group or sector, or to the entire market. The 10% moving average. Moving averages can be used to gather point and figure charts. One of the advanced indicators is based on point and figure moving averages is the percent of stocks above their 10-column moving average, the 10 moving average percent. It can be used to determine the state of the market, if it's bullish or bearish. Now that wraps up today's course in point and figure charting basics.